You're watching Squawk Box. Is the search over? Reports suggest Microsoft has picked a new CEO from within the company despite widespread speculation around external candidates. Google trades higher after hours on solid revenues despite its Motorola loss, while Amazon sinks after warning of a quarterly loss on disappointing Christmas sales. High-end fashion and cognac drive up sales at LVMH, the world's largest luxury goods maker, beating expectations.
Could Spanish banks be out of the woods? BBVA mitigates its losses despite charges on a stake sale, while CaixaBank profit doubles.
And the big question is, BT's big money bet on TV going to pay off? We're going to examine their latest numbers. A day after rival Sky B reported a strong set of results. Right, let's take a look at the BT figures, which are just beginning to hit the wire. The revenue at the third quarter is £4.6 billion sterling. Pre-tax profit has come in at £617 million sterling. The operating profit, £821 million sterling. Right, I'm just going to open up the report and see if I can get you something a little bit more interesting as well. Gavin Patterson, the newish CEO, took over from Mr. Livingston, of course, says an encouraging set of results. Profit before tax up 8%, EPS up 12%. Our strategic investments are delivering. It was another record quarter for fibre take-up, and now further improvements, is that here? There's more to come. Let's have a look. It's 18 million premises with access now. Let's see what else they're saying. Underlying revenue, excluding transit, was up 2.4% compared with a decline of 3.2% in the prior year as well. Earnings per share up 12%. So the headline figure is quite encouraging. Shares have had a good run. They've had a very good run. We're up 48% over the past 12 months. I'll show you a two-year chart as well. That'll give you an even better look at this one. 82% higher BT over the last 2 years, currently trading at 370 pence.
Is it too early still for us to know whether BT television is making a real impact on earnings? What they paid, £897 million sterling for these football rights. Given the conversation we had yesterday with Sky B about the significance of exclusive content, is it too early for us to start to see some traction in the numbers, some evidence that this is bearing fruit?
It used to be quite easy to work it out. Sky had their key USP, which was sport, and then they had movies to a certain extent. Now, as you and I have discussed, whether it's wrestling, whether it's movies, whether it's additional channels, what have you, with content providers going straight down the pipe to the consumer as well, it's a little bit muddier waters to see kind of, that you have a product and who's got it in terms of subscriptions. But there's many ways to market. And I think Andrew Griffiths, the CFO of Sky, pointed out to us yesterday, yeah, fine, we get it. Not everyone wants to have the big 12-month or the 18 or the 24-month contracts. Well, there are many ways to market. And they've got the Sky Store now, Now TV powered by Sky, which means you can almost have a smorgasbord of channels. So it's a lot muddier waters now. So I would suggest, yes, it is too early, but they have paid top dollar. I mean, $1.4 billion for those Champions League rights. Yep. That is double the previous contract that was agreed with the Champions League. So a huge amount of money has been spent.
I also thought it was interesting Andrew Griffiths was making the point that the triple play is still the story, that if you can get the punters in to watch your TV, you've got a good chance of selling them broadband and mobile telephony and a bit of fixed line after that. So it's interesting that even though the iteration of the model has moved on to TV rather than the broadband offering, the message still seems to be the bundle matters here for us to make the incremental revenue stream.
But it's not the bundle, it's the pricing of the bundle. And can they keep up the pricing? That's the key question, isn't it?
Well, I only ever see these companies pushing the price up, not really cutting it.
Yeah.
It's the old, it's clever marketing. It's good bait and switch. They say they're offering you something else, and then the price edges up a little bit.
Yeah, I remember beginning of Jan, I got a letter from one of those providers saying, yep, your prices went up incrementally, but they did go up, didn't they? Guys, I've got some bad news about one of Spain's banks, Spain's Banco Popular. See, I stand corrected. Before I said the bad loans for Spanish banks, they're falling. In fact, for Spain's Banco Popular, they're not. They're rising. The bad loan ratio, 14.2% at the end of December versus 11.8% at the end of September.
Yeah, but we always knew this, though. This is something we bemoaned when they were saying it was only 5-6% last year. And I think Karen was over in Spain last year talking to a couple of these companies as well, if I recall, and they were saying it's fine. We didn't believe those figures at the time. We said they are not marking them down to a market value which is currently trading in the Spanish property market, or what those loans would be trading in the third market as well. I kind of take Jeff's point that he made earlier on today, and I'm going to agree with him.
Oh, God. Oh, no, that's...
I'm going to agree with Jeff, and herein lies the point. Are they feeling more confident now to throw out the bad numbers and get actually to a trading price, to a real value market price of a lot of these assets? They're feeling a little bit more confident they can mark down the value of those assets and say what the non-performing loans are, because it looks a little bit more realistic than at any stage previously in this cycle.
So you think that this is what Banco Popular is doing, and that's why you as an investor should be buying it
rather than saying it's a bigger underperforming loan, it's a bigger loan loss ratio, it's a bad thing. I kind of take Jeff's point, is that at any point these companies can choose to look at the value of these assets on the book and say, shall we mark it down now? Do we feel robust enough in our capital position and in our trading position, in our current position rather than our legacy position, to actually mark these figures down? And I actually wholeheartedly agree with you, Jeffrey.
Thank you. I don't want to bring religion into this too much, but there is a religion analogy here. You know, this is confessional. You know, we're under the cosh for the asset quality review program that the ECB is undertaking, which leads to a stress test that should be credible. This is the time, if ever there were a time, that the banks need to demonstrate how robust their balance sheet actually is. It's a good time to get assets off the books. Either you sell them or you acknowledge that they're non-performing, and then you take the hit on them. And it is also worth pointing out, there was a great story floating around yesterday. Private equity groups in Europe are loaded up with cash, ready to go on the acquisition trail for distressed debt opportunities. So
when haven't they been loaded up with cash over the last 5 years?
And the banks haven't put the product out there. So maybe if the banks are now forced to sell the assets, the private equity groups will step in and start soaking them up.
The banks have been waiting for the cycle to turn around, so they haven't got to sell these assets.
So they didn't have to price to market.
Exactly. Well, you think there's...
So do we agree again?
Yeah.
Shocking.
This is a terrible show, isn't it?
Awful.
First you've got the dinosaurs, then you've got the horses, now you've got all that agreement. Terrible. Let's take a look at the markets. The Chinese markets are celebrating the year of the horse, and that's why Shanghai is going to be out for much of next week as well. As for the markets that are trading today, the Nikkei 225 initially in the green on the back of those better than expected unemployment numbers, unemployment rate the lowest in 6 years. Also, it seems as though Abenomics is working on the inflation front. Core inflation 1.3%. That's the highest in about 5 years. But the Nikkei 225 now down by 0.6%. This is as the yen strengthened against the dollar throughout the trading session. As for the ASX in Australia, the market closing up with some very, very modest gains, pretty much flat though at 5,190 points. Want to show you the U.S. markets because this is where much of the sentiment came from yesterday. The boost to sentiment, the S&P 500 up by more than 1.1%. That was the biggest one-day percentage gain since the beginning of this year. We're moving off those 2-month lows that we hit on Wednesday on the back of the emerging market sell-off. The Dow Jones also up by 0.7%. But the NASDAQ really leading the rally yesterday on the back of those Facebook numbers. Facebook up 14%. Amazon shares, though, down by more than 8.5% in after hours and very high volumes because, of course, numbers missed expectations. Today, we get personal income spending and consumer sentiment following on from that very good GDP number yesterday. Let's take a look at European opening calls. We're expecting a small bounce at the start of the trading session. The Xetra DAX seen up by 17 points after modest gains yesterday. The CAC 40 seen up by 14 and the FTSE 100 seen up by 3.
Carolyn, thank you. European banking stocks started the year on a high, far outperforming their US rivals, but will they continue to hog the spotlight further into the year? Joining us as guest host, Yianos Kontopoulos, CEO and Group CIO at Eurobank Asset Management. Yianos, welcome. Good to see you this morning.
Thank you very much.
Have you got a line on the financials for us?
We're actually repeating the line from last year. We are thinking that one of the differentiating trades or something that would be more idiosyncratic last year would be the US financial system. By the time we got to September, we thought that the valuation difference and obviously the differences in the cycle between the US and Europe favored the European financial system. And the question is this cycle over? And I think that if you believe that Europe is still at a sweet spot in terms of its cycle, then obviously the European banking system as a whole and obviously specific banks have a lot of re-rating to do. Partly, relates to the cycle and also relates to the funding cost, which is also changing. So as the funding cost goes down for European banks, there's a lot of re-rating of what they're holding on their asset side.
Are you as excited as we are about the fact that now many of these banks appear to be acknowledging the non-performing nature of some of the debt that's on their books and are writing it off, or at least acknowledging that it exists?
Well, as soon as you finish your recapitalization process, you can start writing things off. Before that, you can just simply talk about it. Now, in the European setting, they've been forced to come under the light of the regulators, various regulators, I would say ad nauseum by now. So there are probably not that many surprises for us in the next few quarters. If anything, I would argue there is probably process for re-rating.
It's interesting that Mr. Draghi, when asked this question, has said, yeah, there probably will be a few failures. He clearly needs to stand this up as the third round of stress tests for European financials, the last two perhaps not having the credibility that we might have hoped for. Is it necessary that we get one or two failures, and if so, where do those failures occur?
I think the usual suspects. It will either be in the periphery side, where obviously won't be necessarily a big surprise for people who follow them closely, and secondarily, even at the center in Germany. In essence, the holders of those assets who...
A German bank fails the stress test? That's not what BaFin's saying.
Well, I think you have to do it in such a way that you surprise on that aspect too. Don't forget also that there are different incentives going on for the central bank now, in the sense that they are assuming the responsibility, so they want to be as strict as possible on the way there. So if it's something that's easily dealt with, you appear to be balanced, you might get something that's a bit of a surprise on that side as opposed to the periphery.
Yianos, we're seeing all these Italian banks making a dash for the capital markets ahead of the AQR, the stress test. My concern is there isn't enough investor interest out there to snap up shares of all of these Italian companies. So at the end of the day, they're going to be left with very, very low capital levels.
Well, I think it's going to be a combination. If they manage to issue debt along the line, and I think there is an increasing preference, at least for the market, to lend at those rates to the banks, it creates some sort of a complementarity effect. In essence, the more that you realize that financing needs are met, the more likely you are to actually buy the shares of those companies too. I think also it's a timing issue. Once we conclude the process of the banking stress, it will be much easier for those banks to issue equity. So I agree with you. Probably at the early stages might be a bit tougher, but there are some catalysts that might help.
The Eurozone stress tests, they're one thing. The other thing is litigation issues, and we saw with the legs of RBS, Deutsche Bank, for example. We don't know what's going to come out of the Swiss banks next week. It's a very, very uncertain sector to invest in just because you don't know which kind of skeletons are still lurking in the closet.
And I would add, it's not only a question of skeletons. I think if you want to talk about conspiracy theories, both from the perspective of the regulators and also of the political cycle, you want to make sure that you make banks as boring as possible. How do you make them boring? If you reduce the return on equity. And how do you do that? Coming up with any excuse possible to put a fine on. I'm oversimplifying, but this is something that I think we're going to see in the future. Having said that, the question is always for us what's priced in for those banks. And I think a big chunk of it is already priced in.
We're going to come back and pick up the conversation in a minute. You're going to stay with us. And the word of the morning, oxymora. Oxymora. You don't see that very often in a research report.
How dare you call me that?
It's all right, I didn't insult you, I don't think. You oxymora, you. But oxymora, what a great word. We'll come back to that because you have a list of 6 investment directives based on the 2014 call. So we'll discuss that.
Steve Ballmer's successor as CEO will be promoted from within the company if reports are to be believed. Satya Nadella, Microsoft's current head of its cloud computing division, has been tipped to take over the top position. Nadella was born in Hyderabad in India and has been with the company for 22 years, having previously worked for the software pioneer Sun Microsystems. Scorebox Europe, if you want to get involved in any conversations, I'm not reading any silly jokes about West Ham.
Oh, there's good ones on West Ham.
No.
But there was one about loyalty, which I thought was quite good. And a
right?
shout out to Kevin, because I think it's a great combination of emails. One where he talks about the loyalty of choosing a team that is in the area in which you live, and how if you choose a team that isn't in the area in which you live, then perhaps you're not a genuine fan.
Very good.
Good.
There was a joke. There was a joke on Twitter. Shall I read that? I might as well. As soon as we've gone there as well. It was Simon, who's following us or who's on Twitter as well, made a joke about dustbins.
Go on.
Says West Ham put 11 dustbins on the training pitch and asked the players to dribble around them. The dustbins won 3-0. I don't know why I'm doing this.
I like that.
This is
Even
called
I get it.
self-flagellation.
Even I get
I don't know, oxymoron. Self-flagellation. My mate Bob has emailed in as well, one of my oldest buddies, who's also a bit of a Hammers fan, talking about the fat fingers, HSBC and Diageo yesterday. We didn't talk about it much, actually, but basically it was algos being triggered left, right and centre in the market. HSBC had a spike of 10% before raising those gains. Somebody put in too many noughts on their trade. We don't know who it was, but a trader may have lost, according to the Reuters copy I'm looking at, around £400,000, $662,000 in under 30 seconds on Thursday after causing a 10% spike in the shares. It prompted a massive move, circuit breakers going off everywhere. Interesting to see these things can still happen.
30 seconds is, 2 seconds shorter than the average holding period for a UK stock. So I think Pedro was telling us yesterday, 28 seconds, which tells you how much control the computer traders have now.
Well, this happened at 11:20 yesterday, 17 seconds, an order of 18,049 shares at 629 pence, near where the price is trading. Hundreds more orders in smaller amounts followed and drove the share price up to 650, then it got up to 688, and then the shares were suspended until 11:26.
Makes it tough for retail investors to be in this market and make any money, right?
Well, let me just chuck this one out there. If you have your orders queued up, let's say you had a sell order in there, you were hoping at some stage that HSBC got up and you had an old stale sell order in there, all of a sudden, a bit of a bonanza for you actually as well, because you got the tick up.
Could go either way, yeah.
If you had a stop in there, of course, then it's obviously the opposite side of the trade.
All these finger trades and all these
You
algo
never know,
trades.
you might be on the right side of it, probably as many as not. Had a nice little bonanza from that yesterday.
And I'd make the point that I think the one advantage the retail investor has over the professional is time. You do not buy on 28-second holding
I'll give you another
periods if
advantage
you are
as well.
a retail investor.
Because the touch is so small now and the algos are just getting on the touch the whole time and quote stuffing and what have you, if you're a small trader you can probably get on in your size, rather than if you're a decent sized professional or a longer term investment manager, you're trying to get your trade on and you can't because the algos are constantly jumping ahead of you as well. So I think the small trader in some ways has got an advantage of getting filled on their trade. Yianos, got a view on fat fingers?
If you're a retail investor, if you have a baby pressing the buttons, maybe you're going to be as fast. But aside from that, I'll take Jeff's point is that I think one of the tricks here, in this year in particular, one of the directives that we propose is try to be patient. And for retail investors, it's easy. For institutional investors, I think it just mildly changes the strategy. How can you become patient if everybody's looking at your results on a day-by-day or 5-minute basis? And the answer is basically, I would argue, is size your trades. Figure out what do you think is a thematic trade, what do you think is a trend, and don't go all in one go. You have to kind of mimic a strategy that makes you patient.
We had one of the defences of the hedge fund industry yesterday, and it was the word compound. Don't look at 1 year's results. Don't look at compound. Look at us over a longer term period. And I've heard that from other parts of the asset management industry as well. You can't judge us on last year. You've got to look at our longer term performance, iron out those figures as well. And it may be valid, it may not, but that's the defence anyway.
All right, let's move on. Heavy selling across emerging markets continued into this week, despite efforts from policymakers and central bankers to calm the panic. We have spoken to a number of chief executives and asked them whether the sell-off could settle in for the long haul.
Emerging markets used to grow at a composite of 6 to 7%. It's now more 5 to 6%. We have to deal with that. We have seen significant slowdowns of growth in major markets like India or Indonesia, South Africa, Brazil, where we obviously have very strong businesses.
I would not be overly concerned, as I would not be overly optimistic about the European environment. The emerging economies are still pretty strong. There is economic growth, there is industrialization.
There is going to be currency fluctuation, but this is something that we're going to live through, because if we pull back in those markets and then try to get back when currency goes the other way, it's just not going to work. We have to have a consistent strategy and continue to drive our business in those emerging markets.
The emerging markets are a mixed bag. We've had good performance in places like India, Brazil, Russia, South Africa, but we have challenges in the China Baijiu business and the beer market in Nigeria. We've weathered the emerging markets. We know it's not a straight line.
Stuart Culverhouse has joined us around the desk. He's the global head of research at Exotics, and you've joined us to talk about frontier markets. Now, in last year's emerging market shakeout, frontier markets were surprisingly resilient, weren't they? How is it playing out this time around?
Yeah. I mean, that's exactly right. They were resilient last year, both in the fixed income and in the equity space. Some of the strongest performing bonds were in the frontier end of the spectrum, so countries like Ecuador, Pakistan, Seychelles. And in equity space, frontier equities were up 20% last year, so that's an incredible performance. This year, we're still seeing that relative differential between frontiers outperforming the mainstream emerging markets, but clearly things are getting a little bit more fraught with market turmoil spreading across the whole space. We think frontiers can differentiate themselves from the mainstream.
But why would they be able to differentiate from the other emerging markets and also the developed markets when investors can't even differentiate within the emerging markets right now because it's all about contagion?
There's a contagion. You have to do your due diligence, I think, to look at individual country risks. There's a lot of country-specific risks. I don't think you can read across that what's going on in Argentina and Venezuela applies to the whole of the emerging market spectrum. I think they are very country-specific. But I think last week, given the levels of concern, we did see a little bit of that spilling over. But if you look at the fundamentals, frontier economies are still generally growing at quite a strong rate. You look in Africa, some of the strongest growing countries that are investable are in Africa. And that is a little bit different to some of the emerging markets where growth is weakening. We're still seeing reforms in frontiers because essentially you have IMF support behind them, whereas a lot of the mainstream have graduated away from that, and they've seemed to have, I think, seen policy complacency.
I had a question for you in the sense that if we do go into more intense contagion episode, and even taking the example of the more, I guess, appealing segment of the frontier markets, which is in Africa, it has been, I guess, argued to us that in some cases in Africa you have a concentration of funds that they're almost trapped, quote unquote, into that region, primarily because those markets are not that liquid. Yeah. So it's probably the least thing that you want to see if there's some sort of panic that you have the possibility of being trapped, and then that maybe act as a completely different incentive for those investors. Is there something of that sort going on?
I think it's true to say both in fixed income and in equities, particularly in Africa, the investors that we speak to. On fixed income, they tend to be buy and hold. They like African assets, they're buying them and not trading during these volatile moments. And that gives some price support. Of course, if you reach a tipping point and everything repriced, it might be a bit different story. But that, I think, provides some support to the bonds, and we've seen that. In equities, I think a lot of people that are investing in African equities internationally, they have longer horizons. They're not looking at 28 seconds, they're looking at sometimes 3 or 4 or 5 years.
So you believe that?
And I think if you believe the story, and if you get a blip, but the longer term prospects are still, I think, very supportive for frontiers, then if you can ride out the storm, you're not facing daily redemptions, which from a liquidity point of view you wouldn't have in a fund that is investing in Africa, then I think you can withstand some of this external pressure.
I'm intrigued by some of your key calls, top frontier fixed income picks. You like Greek GDP warrants. Well, too bad Greece is now considered a frontier market, but also you like the Ukraine. I mean, it was recently downgraded by the S&P. Why do you want to stick this out if there's no end in sight to the political fighting on the ground?
I mean, we think if you look at various scenarios, and obviously it's a very fluid situation, and even since we wrote this report, which was 2 weeks ago, things have moved on the ground quite considerably. But if you look across...
So you still have that call right now?
Yeah. But if you look at the various scenarios that might play out, we think that one that leads to crisis and default, which is essentially what fixed income investors might care about, is actually still relatively low ranking in the big scheme of things. You still have the potential for Russian support to come through, or if that doesn't come through, then maybe you turn towards the EU. So we think there are some backstops there. And the other thing to say is that from a sort of a debt distress angle, public debt is less than 50% of GDP. So it's not a classic insolvency problem. And we think that should be promising for recovery rates if you do get a crisis.
Can I ask a very basic question? Is Frontier more risky than emerging, given what we've seen in emerging over the last few weeks?
We're a Frontier house, and I probably have to say we say no.
Right, let me ask you a more obvious question then, based on fact. Has it been more volatile than emerging or not?
I think from memory, if you look at some of the equity returns over a 5-year period, and we did some work on this probably last year, generally speaking, I think you'd be surprised that the equity volatility tends to be a bit lower than you might expect.
Frontier is lower volatility than emerging. Now, why on earth would that be?
Maybe it's partly the liquidity point of view, partly the sort of more buy and hold, longer strategy, longer horizons that investors might have. It's not easy to trade these on a day-to-day basis, and that does provide, I think, a little bit of resilience.
Another compare and contrast. The features which have led to the sell-off on emerging, are they still exhibited by the Frontier or not?
I think you can see some characteristics in some countries. For instance, high debts in the Caribbean. You can think of policy complacency in, say, Ghana, where you've got high inflation and wide current accounts. But as a rule, I don't think you can't generalise to say that Frontiers share all those characteristics.
Sure. And you've got 10% plus as Venezuela, Argentina, Belize, or Grenada. Would you invest in any of those?
Grenada's in default, and that might be a recovery story. That's why it's sort of in the table of high yields. We're pretty bullish on some aspects of the Venezuela sovereign and Argentina complex as well.
All right, lovely. Very nice to see you, Stuart. Thank you very much indeed for your time. Stuart Culverhouse, Global Head of Research at Exotics. Okay, emerging market volatility aside, how the world's top business leaders feeling about the investment landscape as a whole. Here's their outlook.
We wanted to just put a stake in the ground and say, okay, assuming a worst case scenario of competition relatively soon, what will the numbers look like? And that's really the clarification on the outlook for 2014. It will be a strong year for Novartis.
We are ready to lend money. It's not I don't think it's lack of funds which is out there. It's lack of consumption, lack of demand, lack of investments, and very low interest rates. So in this environment, we just have to adapt to that. We cannot make magic.
There's a huge amount of headroom and growth in the market to go after. So you may be a case in point. After 25 years of trying to sell you a box and a dish, many more customers continue to want that, as you see in today's numbers. But there's a whole big market of people, in addition to that, who might just want a sports pass for the day or the weekend, or to come in and rent a movie from time to time. That's a market of 13 million households in the UK that we at Sky haven't been able to access before. But going forward, we, as well as other competitors, will go after that market.
We're coming up to the start of the European trading session. That's in exactly 32 minutes' time. Take a look at the futures. Looking a little mixed this morning. The Xetra DAX and CAC 40 seeing some green arrows, whereas the FTSE 100 is seen down by 6 points or so, close to those 6-week lows. We'll be back with the run-up to the market open in 2.
Is your broker taking more than his fair share? Keep more of what's yours with our low-cost platform for professional traders, investors and institutions at Interactive Brokers.
Sberbank is the largest bank in Eastern Europe, with over 170 years of experience and an outstanding international reputation. Committed to excellence, Sberbank is at the heart of the global discussion on the future of finance. On January the 24th, we hosted a breakfast session in Davos to discuss what's more effective at driving economic growth, institutions or leadership. Sberbank, by your side.
Did you know that Russian GDP per capita has almost tripled since 1999? Invest in Russia with Russian Direct Investment Fund.
Ireland is moving forward. The strength of the Irish business model has seen sustainable recovery and return to growth. On Wednesday, February 12th, IBEC, the voice of Irish business, will examine what's next for the country as it moves beyond bailout. At the IBEC CEO conference, a lineup of top international and Irish business leaders will share their thoughts and debate what the future should look like. Register now online and join hundreds of CEOs in Dublin to discuss Ireland's future prospects.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, the UK's #1 retail Forex provider.
Here's the search over. Reports suggest Microsoft has picked a new CEO from within, despite widespread speculation around external candidates. Could Spanish banks be out of the woods while BBVA mitigates losses despite charges on a stake sale, whilst CaixaBank profit doubles? High-end fashion and cognac driving up sales at LVMH as the world's largest luxury goods maker beats expectations. And a record number of subscribers for its broadband and TV service helped BT beat top forecasts as it continues to take the fight to rival B-Sky-B.
We've got 27 minutes to go until the start of the trading session here in Europe. Meanwhile, it was a very quiet trading session in Asia, with many of the markets closed for the Lunar New Year holiday. China, they're ushering in the year of the horse, and that's why the Shanghai Comp is closed. So is the Jakarta and the Kospi, the TAIEX and the PSE as well. In terms of the markets that are trading today, the Nikkei 225 initially seeing some positivity, but then it fell back into the red. This is because the yen continued to strengthen, even though the economic data points we got this morning in terms of core inflation and also unemployment came in much better than expected, and maybe they indicate that Abenomics does work after all. The ASX in Australia is up just modestly by around 1%. European futures indicating a mixed start to the trading day. The FTSE 100 seen off by around 1%, continuing on from yesterday's underperformance when the market was also off by 0.1%. Diageo, one of the big stocks that weighed on the market, CAC 40 seen up by 1%, and the Xetra DAX could add 15.5 points. Keep in mind, we get German December retail sales as well as inflation numbers for the Eurozone and unemployment data as well. I want to take a look at a couple of the Spanish banks. BBVA is one of the companies that posted numbers this morning. Also, Banco Popular out with better than expected numbers, right, Stefan?
Absolutely, and the top line is that the core business lending is picking up in Spain, and that's really good news for the banking industry. All the banks that have reported this morning have posted stronger numbers boosted by two elements. The first one is the lower level of provisions last year on their real estate and Spanish loans portfolio. The second element is the lower deposit rates for the last year, which helped them to improve their net interest income, especially towards the end of the year. Now for BBVA, the bank posted a loss in the fourth quarter. That was expected. It's because it booked a loss on the disposal of a 5% stake in the Chinese bank CITIC, but still the loss on the fourth quarter was smaller than expected. On the full year, BBVA beat expectations with a net profit of 2.2 billion euros, and its net interest income, which is the difference on how much the bank charges for loans and how much it pays for deposit, was also higher than expected in the fourth quarter with a 6% increase. The bad loan ratio, as we were expecting, was a bit higher towards the end of the year, 6.8%. It's a small increase from the third quarter, but it remains well below the average of the non-performing loan ratio for the Spanish banking sector. BBVA also announced its solvency ratio under Basel III, 9.8% at the end of the year. And of course, the outlook, we have some comments from the chairman of the bank, Francisco González. In a statement this morning, he says that the outlook for 2014 has improved significantly as the demand for credit is rising, especially in Spain. So that really is something that should lift the stock at the start of trading. Very quickly, we had also numbers from CaixaBank. It's the third largest one in Spain, based in Barcelona. It more than doubled its net profit last year, but missed expectations because of a weaker than expected fourth quarter. On a positive note, again, the net interest income improved towards the end of the year, and I think that's the main information. Last but not least, Banco Popular, which is a small Spanish lender, returned to profit last year after a significant loss of 2.4 billion euros in 2012. Over to you.
You tempted to dip your toe on the Madrid property market, Stefan? I know it's your second favourite city on this planet.
I was thinking about it, to be honest.
I know. And?
Do you have some advice?
Buy. Buy. Don't procrastinate. Don't pontificate. Buy.
At least.
Don't think about it. Do it. You know you love Madrid.
What's the top rate in Spain compared to France?
What is the top rate in Spain compared to France? You must know this. You must have done your sums.
Sorry?
Top tax rate in Spain. What is it? Do we know?
Compared to France.
Oh, it should be similar. No, I don't know it, to be honest.
It's not similar. It's not going to be 75%, is it?
No.
It's not going to be 75%.
No, definitely not. But don't worry, CNBC doesn't pay me enough to pay 75% tax. But if the management is listening at this time, I would be very pleased to pay 75% tax.
He doth protest
because it would mean an annual salary above 1 million euros.
Our Spain correspondent doth protest too much.
I'm sure Jeff would pay it.
Oh, of course he would. He went through years ago. He was paying it in year 2000. Well, Thank you, Stefan.
Fortunately, I make so much now that I don't have to pay it.
Because you have some tax
I don't know whether you noticed this, but the way that the world works now has changed. So the rich just get richer and the poor, well, they get left behind. So
this is what Davos was all about, wasn't it?
Yeah, absolutely. That was the whole theme for Davos, reshaping the world so that the rich can take even more.
Let us move on and talk about British Telecom and the rest of the telecom arena. Actually, here's a very good question. Where's a question? Nick Stanievich has joined us as well to talk about BT. Is BT still a telecoms company?
Absolutely.
Just a telecoms company?
With some
trying to reinvent
with
itself,
content,
isn't it?
With content, but very much still a telecoms company.
Is the future that BT won't be a telecoms company? It will be a triple play, quad play company.
It will be a triple play quad play company, but most of that quad play will be in telecom services. It's really about broadband.
The boss of BBVA talking to Jeff and I, talking about the big threat to the banks is coming from the technology sector, and don't be surprised if companies such as, in years to come, Facebook and Google start thinking about the banking sector. I can't help thinking of the BTs of this world who are making investment in content, and then I look at the Googles of this world who are not sure what hardware they want to own, but they're buying everything from robots to thermostatically controlled systems. I can't help thinking the Internet of Everything is going to make everyone a bit of everything.
I don't think that's the case with BT. I mean, their core asset is still the hard wires in the ground, and I think over time, as I think the battle with the mobile companies has proven that technologically the bandwidth of wires going through the ground is structurally much higher than going through the air. So So the real asset of this company is its network, essentially.
How's Gavin Patterson getting on? I mean,
very well.
Ian Livingston had a very big share price over 2 years when he was in charge. Gavin's taken over now as well. Is Gavin doing all the right things?
Absolutely, yeah. I mean, today's results were amazing. EPS beat 10%. Broadband net BT again won the battle for broadband net adds. They took 150,000, 60% of the market. They're putting on fibre net adds very strongly. They took 340,000, 250,000 were retail. They now have 2.4 million fibre customers. They have 18 million homes passed.
This is
very, very strong. This is a very strong set of results.
On TV, can BT and Sky both be winners? Because historically, a lot of the guys have come up against Sky and they failed.
I don't think BT needs to win in TV to win the game. I think that BT's strategy is to take broadband market share, inflate its competitors' costs, inflate Sky's cost by bidding for TV rights, whilst cutting its own costs. So taking, so that really holds up the pricing umbrella for the whole industry by inflating its competitors' costs, but by then being able to continue to cut its own costs, it increases its own margins. And that's really the clever thing that BT has done is sort of quality innovation, bring people back onto its own broadband platform, and cut its own costs whilst inflating its competitors' costs. Really.
Can I ask you a question, maybe? And this goes for the sector overall, and it's a concern of us, and it actually touches on Steve's point. If mobile marketing is becoming the thing that drives revenues, in some cases profitability for technology firms, is that also a factor that might start eating up on the positioning and profitability of firms like BT?
I don't think it's today a risk for BT at the moment. Obviously, BT does not have a mobile network. I think companies that do have mobile networks, a much larger share of their capex and profits has been going towards paying Apple for devices. Okay, that's changing over time. I think that'll change over time as the market gets saturated. That power dynamic's going to shift. You're seeing operators already separate handset financing from their packages. You're seeing some operators offering much cheaper deals on bring your own device strategies. Those kind of things, as those kind of things go through the industry, that they're going to reduce the power that Apple has to, or the smartphone makers have to take a bigger percentage of that pie. So I think that's happened already, and it's actually improving for the mobile companies actually.
One channel that at home I have to watch a lot, unwillingly, is BT Sport. Is the gamble, that £1.4 billion gamble, paying off? They've got 2.5 million customers, they say this morning. Are you encouraged by those numbers?
Yes. I mean, I think the gamble is, there's no doubt whatsoever that it's paying off. It's paying off because it's the main part of the reason is to bring customers on, but the perhaps more important reason is to make sure that Sky does not make massive cuts to its prices, and Sky cannot make massive cuts to its prices because its costs are rising. So this is a rather intelligent strategy.
But Sky's got deeper pockets, don't they? So they can easily top up the gain.
I don't think Sky wants to run negative free cash flow.
Should we move this on and talk about the big battle stateside? Oh, go on.
Oh, I just wanted to...
Well, please, go ahead.
Can I have a turn? I think this is what you're alluding to, because I want to know what you do with Vodafone.
Yeah, that's
because AT&T has gone to the regulator in the UK, and they've basically said, no, we don't have a bid lined up here, which means they can't do anything for a little while. So all those people that were thinking, I'll have a little bit of Vodafone on the M&A prospect, what do they do at this point?
That's not actually true. What they've said, that under the rules of the takeover panel, they can't make a hostile offer, but they can make a friendly offer.
Oh, I see.
And this offer would never have been a hostile offer. This would always have been a friendly offer with Vittorio on board.
So do you think it's going to happen?
I think it could happen. Yeah, I think it could. Perhaps soon after the 24th of February, when Vodafone distributes the Verizon shares back to its shareholders. At that point, it can't bid before that point because A, it's too big, and B, there'll be antitrust issues if AT&T bid for a company that owned 45% of Verizon Wireless. Okay.
Yeah.
So after that point, Vodafone becomes a lot smaller, and a bid is on the table.
So my one problem with this is when everybody in the market knows that you may be the bidder, you're going to have to pay through the nose. So how does AT&T get away with not having to pay in excess of 230, 240 a share?
I think it's going to have to pay that. If it wants the asset, it will have to pay that. And I think it could pay as much as 280, in fact.
What other targets do you see in Europe here? Because, I mean, Liberty Global is roaming Europe at the moment looking for acquisitions. I wouldn't be surprised if our own parent company, Comcast, started to have a look around, although I know nothing. But, you know, clearly there are acquirers in the market for assets at this point.
I think the obvious one is American Mobile coming back for KPN.
Yeah.
That I think that's gone away forever. I think that KPN has mostly divested its German mobile asset. That makes it a more manageable size. The poison pill has gone away now in the Netherlands. American Mobile, I wouldn't say, is extremely well funded at the moment. So that might be the limiting factor. But that's an obvious one.
Yeah, we're done. I'll just read an email from Pete at Wall Street Journal who emailed in. Said BT Sport offered an excellent programme on Tuesday. Liverpool beat Everton 4-0. Get over it, Pete. You want to worry about bigger... Do you know what? You just worry about your little Merseyside derbies, and we'll leave it to Man City to win the title, shall we?
Nick, real pleasure. Thanks very much for coming in. Nick Stanievich, equity analyst at Bruin Dolphin.
Hang on, I haven't got to read this one again, have I?
You have.
I'm not reading it all. I'll read the first bit. UEFA's fair play rules are meant to create more financial stability amongst football clubs. However, that hasn't stopped teams from spending tens of millions during the transfer window. Juan Mata became Manchester United's record transfer when he joined from Chelsea for £37 million. Now, that freed up some cash for the Blues, and they have signed Mohamed Salah from Basel. Johan Kabaya is the big transfer for Paris Saint-Germain, paying £19 million for his services. I'm not reading this bit.
West Ham have also been active in the market as Steve's team seeks to solve its goal-scoring problems. The transfer fee hasn't been disclosed, but manager Sam Allardyce says he can't be worse than anyone else they have at the club. Scouting reports suggest a carrot rather than a stick approach will be the best way to motivate. What a great read this is.
Not my donkey. What really gets my goat? Yes, all right, stop the sound effects. What really gets my goat is that's bred by someone who went to his first game at Oxford United and refused to support a football team because they were so bad.
Yep.
Well, what about you're mocking us people who have a bit of raw passion from the East End? Yeah, basically. Yeah, all right, fine. Later on, we're going to be talking about the finances of football with Mark Roberts, Senior Manager of the Sports Business Group at Deloitte, and Jeffrey.
Still to come on the show, slumping profits don't stop Lloyd Blankfein collecting his biggest paycheck since the financial crisis first hit. We talk U.S. corporates next.
The Emerging Markets Data is sponsored by Turkish Airlines. Emerging Markets Data is sponsored by Turkish Airlines.
Welcome to the world of tomorrow.
That was the future then. This is the future now. From toasters to turbines, almost anything that uses electricity can now speak to us and each other.
Autonomous driving.
That is wild.
But we're absolutely in a science fiction world.
Witness the rise of the machines.
We're living in a time where information is moving so quickly, where there's so many sources of information. But this is still a place that occupies rare space, the last place for thoughtful, balanced conversation. My obligation is to keep pushing to try to get a real answer. For me, there is no greater job than this. There is no greater role to play than to be moderator of Meet the Press. I'm passionate about this job. I love this job, and I want people to feel that.
If it's Sunday, it's Meet the Press.
Right, luxury group LVMH posted an 8% rise in like-for-like sales for 2013. A pickup in cognac and its Louis Vuitton brand. The CEO, Bernard Arnault, says the group now faces production constraints with long waiting lists for its luxury leather good. That's amazing, because we saw Mulberry, of course, suffering so badly because of lack of demand on a lot of its luxury goods. Anyway, LVMH, I guess, could be in a different bracket. Shares in LVMH are down nearly 13% over the past 3 months. Carolyn.
It's not the top-tiered brand that the Chinese are looking for. That's the thing, right? It's somewhere mid-tier.
What is the top brand? Is it LVMH or is it Hermes or?
I think you've got to ask Karen about that.
I don't agree with you. You know, you go to the. You've only got to go to the LVMH.
When we need?
Go to the LVMH store in Paris, and you see the line of Chinese waiting outside to buy in that store. And the way the store operates is they control the number of people inside. And I always, whenever I see it, I just think this is just nuts.
They're hoping to make a bargain, and they're hoping to resell it ahead of the Chinese New Year holiday. They're hoping to sell it online and make a nice arbitrage trade out of it. Not
Paris,
because they really want the product.
Faubourg Saint-Honoré. I can say 1990 when I was at Lyonnais, and I can honestly say it was the same story then. I mean, yes, I know there's more Chinese tourists now. I know there's more demand. I know there's a bigger middle class, but it's always been the case.
That's why I think, you know, the strategy that Apple is pursuing as it follows Nokia down the road of actually downscaling its key brand, you know, its key product. Really big question marks over whether that actually works in the emerging markets where status is so important. And even though you probably live in 500 square feet, you own some of the best brand names that are in the marketplace.
But the 5C worked pretty well in China, didn't it? Or at least in the emerging markets, the 5C.
Story remains to be seen whether they can go down. I think
with the China Mobile
question
deal.
marks still whether they go down that quality, well, it's not a quality threshold, but the pricing points and still sell.
Okay, let's move on. Shares in Amazon dropped in after-hours trading as the group missed the street on holiday sales and cautioned over the quarter. The world's top online retailer said it expects operating results for the current quarter to range from a $200 million loss to $200 million in profit. The Seattle-based group doubled net income to $239 million, but missed estimates with EPS of only 51 cents a share.
It was a different story for Google, with shares climbing after hours as the group's fourth quarter profit rose on higher advertising revenue. The group reported net income of $3.3 billion in the fourth quarter, with total advertising revenues rising 17%. Revenue from its now Lenovo-owned Motorola mobility unit dipped 24% to $1.1 billion. Quick story on the wires here. Sberbank sees 2014 GDP growth at 2.2%, inflation at 5.5%, oil at $100 a barrel. Sberbank sees corporate loans up 11 to 12% for 2014, retail loans up 20 to 25% in 2014, loan growth above market, 2014 net profit slightly above the 2013 net profit. I had the opportunity to speak to Herman Greff, the man who runs this business, while we were in Davos, and I thought what was interesting, I said to him, you know, if you look around the world, where do you think the opportunity is to make the greatest return on capital at the moment as a bank? And he said, domestic market, Russia. And then I looked at those inflow numbers yesterday, I think. Russia ranked third, I believe, in inflow, FDI flow for 2013. Now, we thought this was a story of capital exiting Russia, but it does seem to be coming back here. I just wonder if you know, given the risk premium that remains in the price, whether now is the time to dip your toe into the Russian market.
Yeah, well, it's tempting because the numbers are getting there. It is tempting. You cannot ignore valuation issues. The thing that's pretty special with Russia is the political risk and the political issue. But otherwise, you're probably there in a sweet spot too, in terms of both the oil dynamics that you have and also the ability to sustain actually a weaker exchange rate and position it any way you want. The central bank president made just a slight comment yesterday, and things turn around in a nanosecond. Why? Because they have hundreds of billions of reserves at this stage. So they can pretty much dictate the number and take advantage of the flow. So you're buying at a weaker exchange rate, and you're buying at a very good valuation point. You need to have some sort of visibility with respect to the politics, which nobody does. So I mean, is
this an oxymoron? We said this is the word.
I guess it is. But it's always the case with emerging markets. The best point and the best entry point for emerging markets is when you actually feel more uneasy about making that move, because you know that you're not with the crowds. So I would say that I would argue that it's tempting, even for people who dislike Russia.
Just want to make 2 points. One, the P's on Russian equities have been low for a very long time. It's not a recent phenomenon. It's not necessarily a financial crisis phenomenon. So I would suggest that, yes, they look cheap compared with Western assets, but they have been for a very long time. Second point I want to make is back to these FDI flows. You seem to have forgotten last year, Jeff, and the fact that most of this FDI into Russia, certainly up to 2013, was Russian money which is just being recirculated via places such as Cyprus and what have you. And I notice on your list of the top-ranking FDI, the fourth is the British Virgin Islands. So I'm not saying where the Russian money is coming from, the FDI. I'm not saying that there's anything wrong here as well. I'm totally not saying that. What I'm saying is money is being circulated out of the country and it comes back in again as well. We see it in China, we see it in Russia, and we see it apparently in the British Virgin Islands.
What was interesting, though, when we stood on that platform at Davos, we had a number of CEOs who came through who said that they have increased investment. So WPP bought out big stake in a joint venture there, so they raised their stake. Kasper Orsted, Henkel, told us he'd just sunk more money into manufacturing operations in Russia. Again, this is one of those interesting stories that we've got, one of those oxymora, where the financial markets are doing something different to the real investors, the business community, who continue to believe in emerging market demand dynamics.
But I want to also shock Steve with respect to his first point, which was my initial reaction when I looked at it. Yes, typically the PE in Russia is significantly lower than the average, but do you have any idea where it is right now? Can you venture a guess how low it is? It's a little bit less than 3.
Wow.
So that's shocking to me. I mean, it made me actually wonder, okay, maybe I should. It's typically 7 or 8, and that's below the average. But at 3, I have to look at it.
Yeah, and the other thing is the government is forcing these companies to start paying dividends now. So you do get a yield, or you will get a yield, I guess.
Can I answer a question which we asked ourselves? Top rate of Spanish tax. Actually, do you know where this came from? It came from our chap in Owen in engineering. Obviously not busy enough engineering. Owen, hi. He's given us the tax rates. If you earn over 300,000 euros, so you and Stefan, Jeff, 51.5% is the tax rate. This is SpainAccountants.com. £175,000 up to £300,000, you pay 50.5, then it goes down to 48.5. If you earn under 33,000 euros in Spain, you pay a tax rate of 29.3%.
All right, we've got about 2.5 minutes to go until the start of the trading session here in Europe. Taking a look at the futures, looking mixed. The Xetra DAX, the CAC 40 is seen just modestly higher, while the FTSE 100 is seen flat to modestly lower. We'll be back with the full market open after the break.
An elite group of CFOs representing public and private companies across all major sectors come together to share their unique insights on the challenges faced by the most influential individuals in businesses today. The Chief Financial Officers. Exclusive interviews, surveys and polls at cfocouncil.cnbc.com.
EY, exclusive sponsor of the CNBC Global CFO Council.
Mobile technology, the biggest development of the 21st century. What is next? How will our lives change? The GSMA Mobile World Congress is creating the next big innovation. Network with other industry professionals. Explore the largest exhibition of its kind. Attend the conference featuring today's top CEOs or drive innovation with the best featured programs. Join us in Barcelona this February, where we are creating what's next. Learn more at mobileworldcongress.com.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, the UK's #1 retail Forex provider.